What's up? What's up? Tuesday night, 5:30 p.m. We are back for an all-new episode of What Are Your Thoughts? The best, I would say, live stream in all of YouTube, finance YouTube, investing YouTube. Hey, I installed this AI thing for my emails. So if you email me, don't get upset if you don't like the response. It's usually not going to be me. Is that okay?
Is that true?
Yeah. The problem is that the chatbot that I installed, it turns out, is super racist. So I have certain friends that I had to call and be like, definitely don't email me this week. We're still working out some kinks.
Anyway, what else is going on?
Nothing. Did you know that I'm thinking about replacing you on the research division with AI?
Good.
Yeah, it's called Bat GPT, and it's like a Batnick, but like an artificial Batnick. What do you think? You're gonna have to train it though before we let you go.
I'm into it. This is getting weird.
You're gonna have to. All right.
Oh, I just noticed your name.
Tell me about your shirt.
Episode 2. Before we get to the shirt, episode 2 of Last of Us was
that?
Holy moly,
Fully infected.
rocket ship. Yeah, I'm infected. First of all,
God. This show is just slitting your throat. They're not even waiting till season finale. It's amazing.
I'm all the way in. All right, so this shirt has a couple of meanings. First of all, this is Tropical Bros, as I'm sure you know by now. It fits well. I mean, obviously, it looks great. These guys got flamingos. So
really, I thought it was Gucci.
No.
All right,
no,
Tropical
it's not.
Bros.
The okay. Tropical Bros is a Gucci of leisure attire. So, Future Proof is an event that we are hosting for the second time, and you better believe that this is gonna be my outfit of choice.
The whole time.
The whole time.
Will you mix it up? Will you'll have multiple?
I have a dozen of these things.
You and Ben both wore the Tropical Bros shirt for the live podcast taping at Future
next
Proof
year,
1, right?
Hopefully, we'll wear an Animal Spirits themed one. We're working on a collab, so we'll see.
Hey, if you work in finance or fintech or wealth management or whatever, and you want to attend Future Proof, now is the time. Prices are going up in February. You could buy a ticket in February too. I'm just saying it's going to cost you more. And tickets are going. So we're really excited about that. I want to very quickly say a quick congratulations to our research associate, Sean. Sean Russo joined Ritholtz Wealth and by extension the Compound 1 year ago this week. And Sean has been an incredible addition to the team. Michael, what would you say about that?
Did you like my tribute today?
That was very nice of you.
Yeah, no, he's been a life savior in so many ways. So
life saver, not savior. Life saver.
I said
life
saver.
You said life savior.
I did not. Get out of here.
You did. That had religious overtones.
Run it
life
back.
Saver.
Did I say savior? Yeah, maybe I did.
We have a birthday in the pound right now. One of our day one viewers, listeners. Amazing addition to the chat each week. Roger Weatherford, happy birthday. We appreciate you coming here for the live every week. I hope you're here today. I didn't see you yet. But yep, there you are.
Happy birthday, Roger.
Listen, you're the man. Happy birthday. All right, let's get into
you don't meet a lot of Rogers these days. It's like one of the names that just disappeared into the ether. It's a good name. I
think people stopped naming their kids Roger in the 1960s. And like the last of the new Rogers came out in the 80s. Do you think that's accurate?
There's no new Roger. I don't know Roger besides Weatherford. I mean,
there's not Rogers under 40, but there should be. That's one of the names that should be brought back.
You know, I feel like it might come back.
They all come back.
Yeah.
They all come back. Roger will come back too. Happy birthday, guy.
Happy birthday.
All right. Microsoft reported earnings, and let's just to put a cherry on top. This is probably one of the most important companies reporting in all of earnings season.
It's the biggest. No?
Is it bigger than Apple?
Yeah, I think so.
Okay. And even if it's not, it's what they have to say is always very important, just given their view of the environment, because they operate in so many areas of the economy. And Michael, why don't you take us through some of these numbers?
Alrighty then. Nope, I apologize. It is not bigger than Apple. Not even close. Okay. 2.2 versus 1.8. All right.
Good start, though.
So we're going to set the stage. Don't be rude. We're going to set the stage with where they came from. Chart on, please. All right. So we're looking at quarterly revenue. Not quite at an all-time high prior to this. Free cash flow. I mean, these are all beautiful things. Operating margin. It's all up and to the right. Here's what Satya Nadella said in the earnings report. The next major wave of computing is being born. As the Microsoft Cloud turns the world's most advanced AI models into a new computing platform, we are committed to helping our customers use our platforms and tools to do more with less today and innovate for the future in the new era of AI. You agree?
More with less sounds like layoffs for everyone.
Well, that's that they just did that. We're gonna get to layoffs later, but let's throw up the consensus gurus, which is powered by Quarter, just to give you a sense of where they missed, where they beat. A little miss on revenue, a little baby miss, but guess what? That actual number, that's an all-time high. Operating margins down a little bit. I'm sorry, operating margin beat, gross margins missed. All right, pretty good. So let's get to some of the stuff.
Okay.
So Intelligent Cloud, which includes Azure, there was obviously negative currency impacts, as you could see in the middle chart. That's growth. On the right is currency, constant currency, so adjusted for the strong dollar. Cloud's still growing. If you just look at Azure, which is obviously the crown jewel of that, I think it's growing at 29%. So pretty incredible numbers there.
We should say Microsoft, as of this recording, is up about 10 points, which is 4%, and the stock closed flat today. So I would say a very good reaction given the size of this company. A 4% move is not nothing.
No, it's many billions, tens of billions.
Yeah, one of the headlines I saw, though, was that cloud is slightly slowing, but I guess not enough for people to truly be concerned.
The growth rate a little bit is plateauing, but all right. It's still doing 30%. I mean,
it's gigantic. I suppose that's understandable. Microsoft had the weakest bounce out of all the FANG stocks off of the lows, so maybe a little bit of this is just playing catch up. But it probably had the weakest bounce because it went down the least. You think that's fair to say? Like Amazon got cut in half.
It bounced the hardest
because Microsoft didn't get cut in
half.
half.
Let's
it bounced the least
because it got hit the least. Is that what you're saying?
That's what I'm saying.
John, let's fast forward to the Alex Morris chart. All right, so cloud run rate revenues are up over 5x over the past 5 years.
Crazy.
To $108 billion. Unbelievable.
And this wasn't even like their primary business as recently as 5 years ago. Like it was I guess it was an important growth business for them, but it wasn't. I don't know that most people thought it would get to where it's gotten.
Well, this is what Alex just said. Like this is nearly equal to their total revenue in 2018.
Yeah. Satya Nadella came from the cloud part of Microsoft, and I think when they put him in charge, there was some symbolism there in that the company was recognizing this is our growth engine for as far as the eye can see. Like it's not an accident that he happened to have come from cloud and cloud has turned into this. I think they saw it coming.
LinkedIn is still growing. We talk about that every quarter. Still growing, up another 10% their revenue, 42% currency adjusted. It wasn't all great. Next chart, please, on cash flow. So what does this say? Cash flow from operations was down 23% year over year. There's a big tax payment with the Tax Cuts and Job Act. But even X that, it declined 7%. As strong cloud billings and collections were more than offset by higher employee and supplier payments. Of course, they're doing something about the employees. They did cuts, which again, we're going to do later. Free cash flow was down. Okay, exclude that. Down 27 points for tax payment. Okay, exclude that. I'm sorry, it's down 60%. So it wasn't all great, but
the way to read a tech earnings release is to exclude everything that's bad. And,
no,
and just keep all the good
stuff.
That
was a one-time thing. That was a Tax Cuts and Jobs Act. But even still, adjusting for that, it was down 16%. So it wasn't all great. But I guess people were expecting worse.
I think people were expecting a weaker consumer tech contribution. I think it's pretty clear that everyone during the pandemic was binging on electronics, and that obviously that couldn't continue. And you pull forward 3 or 4 years worth of demand in certain areas of tech, like it's going to take a while to work that off. And I guess we're seeing it, but it turns out not to be as important in the mix shift for Microsoft as some people might have worried about.
Gaming got smashed. And hardware sales were not good either. But Thoma Bravo was in Barron's, and he's the founder of one of the biggest private equity companies in the world. It does a lot of tech buyouts. They said, what are you hearing from portfolio companies about the outlook? It's not that bad. In the June quarter, purchasing managers were really pulling back. The September quarter was soft, but the December quarter was pretty decent. I feared the fourth quarter was going to be surprisingly bad, and it was not. I didn't see anything nearly as bad as what we saw in the financial crisis or what we saw in the first 2 quarters of COVID. So we're about to find out. Listen, Netflix crushed. Microsoft, good enough. We're going to hear from, I guess, the rest of the giants next week, I think.
Which one are you most worried about?
Well, Facebook. I own it, and they're in the advertising business, so.
Yeah, I think Facebook and Alphabet are going to be interesting. I own Alphabet, full disclosure. Those are the ones that I feel like if any of them are going to be immediately impacted by the new environment, it's got to be ad related. And those two, 90-something% of their business is ads. And there's no way around that. You could talk about all this other shit they're working on, and that's great. But like, they're ad companies, and ads are slowing down, period.
So ads are probably the most, or one of the most sensitive areas of the global economy in business. If they don't show a slowdown, what do we think? What's the narrative then?
I don't know. You could go either way. You could say, well, those are the 2 blue chip advertising platforms, so it makes sense that people are sticking with that and probably
bullshit.
cutting back advertising elsewhere. No.
Okay. I mean, you could say that. You could say that.
Broadly speaking, I want to do this thing about enterprise software because there was a very bearish call that came out of Deutsche Bank, and I think it's somewhat related to what we're talking about. But basically, the guy is saying this could be the toughest year for enterprise software companies in a long time. This is an analyst named Brad Zelnick, and he covers a lot of the high flyers that we talk about and that people trade. So this is his quote. We expect 2023 to be another volatile year for software stocks, with investors seeking confirmation of a bottom as fundamentals likely deteriorate further. This is the most difficult outlook piece we've written in our combined decades covering the sector. With the weightiness of macro factors, more dimensions to the analysis, and a wider range of outcomes, we struggle to have conviction near term, though ironically, we couldn't be more resolute in our thinking about the long term. So basically, like, this might be a tough year because a lot of companies are doing, frankly, what we did at our firm, which is just what is all this shit we're subscribed to? What is everything we're paying for? How many of these things can be consolidated to one vendor? How many of these are contracts that we just didn't care about?
Well, who's in the epicenter?
That we can now renegotiate?
Salesforce.
Well, Salesforce, clearly, and that's written all over the stock price. And I think that's because it's the biggest line item for Fortune 500 companies in all of their software spend. And then I think secondarily, there's a lot of HR software. Workday is like a very prominent example. And if you're laying people off and you're looking to spend less on your labor force, you're probably also looking at your software costs related to that labor force. So I feel like, look, I could be dead wrong, but intuitively it makes sense for me that you're not going to be hearing about record contract wins from any of the high-flying software SaaS.
Well, guess what? Especially because who are their clients? It's other tech companies that are clearly in a recession.
It's how about venture-backed startups that would have just signed a contract for 200 heads,
right?
200 desks, all these people they hired. They're not hiring at that rate, and they're actually firing. And there's just no way that those are going to be easy to replace as they fall off. So I think it's a smart call. It's probably what's going to keep me out of that area in the market this year and not get fooled by rallies. Let's put up the software sector ETF chart. This is 3 years, so it encompasses most of the all of the post-COVID period, and then the run-up into the recovery, and then of course the horror show that was 2022. And, these are great companies that comprise this index. And it's pretty much as though the pandemic demand pull forward is completely unwinding all of the benefit of that at this point.
This drawdown is not as bad as I would have thought. It was 45% at its worst. It's now down.
Yeah, but there's big software stocks in there.
It's now down. It's now down 38% off its high. So I'm looking. So Salesforce is the biggest holding.
I bet you if you equal weight this, it's a complete shit show.
Salesforce, Adobe, Microsoft, Oracle, Intuit, ServiceNow. Those are the big ones.
Let's pull up this Microsoft revenue chart. I just thought this was in the Wall Street Journal. I mean, this is just incredibly impressive for a company that's circa 2016. Everyone looked at it and was like, "What is this? Like Windows? Like what? How are they ever going to grow? It's boring. It's stagnant.
Incredible
Palmer.
reinvention.
Really is like one for the ages." And
absolutely.
you could do a lot of stuff with earnings per share, whatever. You can't fake revenue. Revenue is revenue, and that really tells quite a story of Microsoft's comeback.
And that's how they got to $2 trillion. I mean, they absolutely crushed it. All right, let's talk about this. So I want to ask: is the bear market over? And let's get into some charts. So
No.
This is from Warren Pies. Warren,
Friend of the show,
314
former
Research says, if we avoid a recession, the lows are likely in. Non-recessionary bears are short and shallow.
If I stop eating carbs, the highs are probably in. Like, come on.
What do you mean, come on? Hold on, shut off.
That's the thing, though.
I take umbrage with that statement. What are you talking about? He's saying that if we avoid a recession. But what?
Who would argue with that?
I don't
Doesn't
know.
that seem obvious?
Why are you being so combative? Who's arguing with anything?
All right, I'm not.
Nobody's arguing.
No, that just seems like a very obvious. Doesn't that seem like a really obvious, super obvious statement? If there's no recession, then the stock market is bottomed.
Next chart.
Like nobody would argue with that.
However, if we do enter a recession, the bear has further to go. So the previous chart showed all the bear markets that were not accompanied by a recession. Great work, John. Thank you. The next chart shows all the bloodbaths: 29, 68, 73, 07, etc. So,
you know what I was doing, Mike? You know what I was doing wrong? I'm sorry. In my head, you said if we have a recession. I was thinking if we have a bear market. Like I was saying, of course the lows aren't in if we have a bear market. I'm sorry. It's, you know what? You're right. My bad. Okay. That was overly combative, and I wasn't even really hearing what you were saying.
Well, I appreciate it. It's very big.
Put the second chart back up, please. So can you tell us what some of those colored lines are for the people who are watching this on a phone?
Okay. So the blue line is 1929. That is obviously the worst we've ever seen.
Scenario. Right.
And I believe the other long one, which one is that? Let's see. I don't know the end dates. So what's another long bear market? I'm going to guess 2000 because that went 3 years.
The red one is 2000.
Yeah.
March 27th, 2000.
Okay.
And that one stands out to me. And that, can I tell you, just like thematically, that's the one that to me feels the most similar to this one.
Well, yeah.
In a lot of ways.
Yeah.
So tech bubble, like way too much demand pulled forward. In that case, people were buying a lot of shit before Y2K, which sounds hilarious now, but it's true. In this case, it was because we thought we were all going to work from home for the rest of our lives. But thematically, that one was the same type of bubble that this one is. This one arguably was a bigger bubble, at least in dollar terms.
Okay.
So let's hope we avoid it.
We got some more charts to rip through. All right. This is from Shane Murphy. Shane says, does your recession playbook include high beta stocks forming new 52-week relative highs? So on the bottom is the S&P 500, and on the top is high beta divided by the S&P 500, and it's breaking out.
Wait, can you explain this?
The blue line is the high SPHB, which the top holdings are. It is equal weight. It's Nvidia, Etsy, AMD, Carnival, Caesars. So these are names that move. High beta names, just as it implies. And it's one divided by the other. And it's breaking out.
So it's a ratio of high beta versus the S&P. When was that? So it looks like that top was the middle of 2021, and it's headed back toward that level.
This is like a JC chart. Like investor enthusiasm peaked in early 2021, and it's approaching 52-week highs. So it's a fair question. Listen? Now that the market's always right, but it's a fair question.
The bears are basically looking at that phenomenon, and they're saying these are stocks that were under tax law selling pressure for the last 3 months of the year, and that has magically disappeared. And now they're lifting, but there's no fundamental reason for the stocks being up. And as they start reporting earnings, they're going to head right back down.
Okay, could be.
That's the bear case on high beta.
JP Morgan said 7 of 9 asset classes from high-grade bonds to European stocks now show less than a 50% chance of a recession. Inside of that basket are stocks, credit spreads, base metals, treasuries, European stocks. And this looks to be quantitative in nature. That's not their opinion. I mean, it is their opinion, but based on a model. So 7 of 9 show a less than 50% chance of a recession.
How do they calculate that? They look at the pricing of these asset classes during previous recessions, and they say that's where these things would be trading.
I don't know what their flashing red lights are, but they're not flashing.
Okay. I feel like this is the kind of thing that could change really fast.
Of course it could. So listen, Ben and I were just about this today. Like, is the market getting out over its skis? Are we anticipating too much of a less bad earnings season than we might have priced in 3 months ago?
You know what? I'm not sure, because there's still a lot of bearishness. Like, even Wall Street forecasts for this year, and we talked a lot about this in December. Like, there are very few people in a position of being the spokesperson for a large firm who are even saying the S&P could be up this year.
Exactly. That's my point, though, is that the market, forget about what they're saying. Like seriously, just look at price. So when I was picking charts tonight, when I was going through charts, like make the case for a stock tonight, there's a lot. I mean, I was looking at like something as simple as gold. I'm looking at biotech, like the XBI names look really good. The airlines look good. There's a lot of the non-profitable there's a lot of really good looking charts. And yeah, they might all get busted up when earnings report, but guess what? Maybe they don't. Maybe they don't.
If they stay where they are, they're going to flip a lot of opinions just because.
If earnings if earnings don't shit the bed, what's the bear case? Oh, just wait. Like we're gonna go into recession. So think about how much Netflix was up going into earnings, and how much is it up over the last 3 days since it reported? Another 15% or so. Think about the run that Microsoft's been on, and look what it's doing in the after hours.
I'm sticking by what I think, which is that we're going to have a shocker and non-farm payrolls one of these coming months. I don't mean forever. Like, I'll put a time limit on it. I think between now and the middle of summer, one of the next 5 months is just going to be an out of nowhere, oh my God, everyone is fired. And when that happens, I think that's when you'll see the soft landing thing get thrown out the window.
I think
that's my personal opinion.
I think I respect the call. I don't agree, but I respect the call. So let's look at some charts about stocks above and below their 200-day moving average. What is in the NYA?
What do you mean? What's in it?
What is that? What index? Is this New York Stock Exchange stocks?
It's like a composite, isn't it? Isn't it a composite of all the New York Stock Exchange stocks, which also includes closed-end bond funds and other things that trade on the New York? But this is stock specifically, right?
Okay. Yeah, because it looks exactly like the next chart. So yeah, it looks exactly like the S&P.
Okay.
So 65% of stocks are above their 200-day moving average.
That's not bad. That's actually pretty good.
I mean, dude, it's the highest it's been in a year.
We had a rough market in December, but nothing like June or October was, and a lot of stocks just didn't participate in October, and really didn't get hit that badly in December. It was really just giant tech companies that were giving people trouble, but like an underlying the market of stocks itself is pretty okay.
Well, yeah, we've been talking about like the equal weight looking much better, much better. One last chart. Look at the Nasdaq, which have been getting beat up pretty good. This will look better tomorrow, I'm sure.
Oh yeah, tomorrow, barring any major surprise, should be a big green.
So I'm saying, what's a surprise? You know what the Fed's going to do? It's all about earnings right now.
We know what the Fed's going to do 25 basis points and then 25 basis points and say they're done.
And then they're going to pause. What's the bear case?
I'm just going to tell you there's only one bull case, and it's look how strong the jobs are.
What's the bear? But dude, what's the bear case?
Nobody's saying earnings are about to collapse, by the way. What I'm saying is earnings don't necessarily have to collapse. If all of a sudden the labor market turns out not to be as tight as we thought, it'll be great that stops the Fed finally.
But all of a sudden, why would that happen all of a sudden?
Because it always does. Because as much as we can predict PPIs slowing down and all that shit, what always happens with layoffs, it's always a shock. It always sneaks up on people. Oh wow, things are worse than I thought.
But you don't think you're going to see initial claims like start to tick up? You think it's just going to be a shock out of nowhere? It won't show itself in the data?
Yeah, I do. That's what I think.
Okay.
I don't think it's going to be like, 1 month we miss the jobless claims by 3,000. I think it's going to be one of those months where they're expecting 100-something thousand and they get negative 100,000, and then everyone says, "All right, wait a minute, this has gone further than I thought it has." That's what I think. So it's by the way, it's not. That's what the Fed wants to happen. So I'm
Yes.
not, what I'm saying is going to happen is like literally what the FOMC is trying to have happen. Like I'm not saying anything controversial. It might sound on the surface like, oh my God, he's predicting doom. I'm really not. Like that's the thing that gets the Fed to stop. And then where the conversation shifts to is it already too late? You'll see. That'll be the new shit.
They're going to pause and they're going to see how these hikes, the 7 hikes, have worked their way through the system. So we'll see. All right, next one. We good here?
Okay. Yeah. 7 hikes is understating it. Because some of these hikes were 75 basis points, half of them. So, all right, let's do happy 30th. Is it a birthday or an anniversary? The first ETF. I guess it's a birthday, right? So this is kind of a big deal. Bob Pisani wrote this for CNBC.com. 30 years ago this week, State Street Global Advisors launched SPY, the first U.S.-based exchange-traded fund which tracked the S&P 500. It is the largest ETF in the world, $370 billion in assets, also the most actively traded, routinely trades 80 million shares a day with a dollar volume north of $32 billion. I would also add it's become the de facto benchmark for pretty much all U.S.-based investors. Most investors do not look up what the S&P 500 did in any given day. They type in SPY. It's become a shorthand for the U.S. stock market. Whether or not it should is a different conversation. But this is fundamentally one of the most important inventions in the history of American finance. Would you agree with that?
Yes, I would. It didn't really get above $100 billion in assets until like 2012. And now it's at 370. And there's a lot of competitors too that have a lot of assets in S&P 500.
Yeah, Fidelity's got mutual funds and ETFs that track the S&P 500 that are also massive. But this one is this is the granddaddy.
IVV is another 300.
So I told this story in my book, Backstage Wall Street, about the first time I ever heard of an ETF. And we actually had a wholesaler from the American Stock Exchange, which is where all of the original ETFs were trading. They did not trade on the New York. They did not trade on the NASDAQ. So the Amex sent up a wholesaler to my broker-dealer, and we had about 35, 40 brokers in the room.
JT Marlin?
Pretty as close as you get. But like we all looked at each other and didn't really understand. It was baffling, just the concept of, wait, let me get this straight. It has a ticker? Because we were selling mutual funds. So it has a ticker, but I can get out an hour after I buy it. The guy's like, you can get out a minute after you buy it. And I'm like, and it like represents the price of the S&P in the same day. He goes, every day, every minute
all
of the day.
Yeah.
It's designed to track. And we were just like blown away. And actually, he wasn't just showing us SPY. They already had the sector spiders, and he had these stuffed animal spiders that he was like throwing around the room. And for me, once I got a stuffed animal, I was in. Like that, it took a lot of due diligence for me. But we started trading them like that week and never looked back. And that's got to be 2001, if I had to guess. So it's just amazing that this is already 30 years. For the asset class itself. Pretty impressive.
Between Vanguard, iShares, and State Street, they've got $940 billion in S&P 500 index ETFs.
And what's the total amount of the ETF business right now? Do you know that number offhand?
Trillions. I mean, obviously trillions. I don't know. 10?
So it's worth just mentioning this. In the year 2000, ETFs had $65 billion in assets. By 2005, only 5 years later, $300 billion. And by 2010, $991 billion. But it really wasn't until the aftermath of the financial crisis that a lot of financial advisors and retail investors looked at the carnage and just said, you know what? What am I paying for active management for? And made that shift into SPY. And that's when I think the ETF business really hockey sticked. Do you think is that a fair characterization?
Yes. And if you think about the advancement and the innovation, like most financial products do not help investors' bottom line. the ETF is an outlier, but the advancement that they've seen in recent years with what can be packaged inside of an ETF wrapper is miraculous.
Yeah, you could almost even package Bitcoin into an ETF, I feel like, someday. You could do anything but Bitcoin in an ETF right now.
Well, actually, to that point, DataTrek tweeted, it took almost 3 years for the SEC to approve the SPY ETF, and that serves as a good reminder that even the most useful disruptive innovations in financial services must run the regulatory gauntlet before they see the light of day.
A-plus tweet from Nick. I didn't realize that.
Hell yeah.
3 years.
Hey, I was talking about this with Ben on Animal Spirits today. Google Mail search is horrific. I'm trying to find an ETF, an email that went out from State Street earlier this week about the 30th anniversary because it had all these numbers that we're talking about. I can't find it. I can't find anything in my Google inbox.
I blame BatGPT. The AI that I hired is already clearing out your inbox. You're
how
pretty
come
much being cut out of the picture?
I'm sure there's a reason. How come when I put State Street into my thing, everything that has the word state or street comes up in my box, which is everything.
What? What do you mean? Say that again. When you put state or street,
I'm looking at. I put State Street in my search bar in my inbox.
Yeah.
And the results are
as one word or as 2 words.
As 2 words. It's 2 words.
Okay. So then, if you're going to do that, then you want to use quotation marks around them.
I tried that. Didn't work. Everything is coming up. Horrible. Anyhow,
this doesn't bode well for Alphabet's earnings.
All right, let's move on. I have a question for you. And I know we're not going to get to the bottom of this, but maybe somebody who covers the industry or the sector can email us and let us know what's going on. Why are consumer staple stocks so expensive? And I'll tell you what I mean in a second. First of all, let's throw up this chart that I put together. These are the market caps of some of the giants. You know all the names, right? These are literally things that we use.
Walmart, Procter & Gamble,
every
Coke,
single
Pepsi,
day.
Costco, Philip Morris. Okay, go on.
These just household goods. Household goods. All right, let's look at the PE ratio for these stocks.
What the hell is this?
What's happening here?
I don't know what the PE ratios for these stocks were 2 years ago. My guess would be a lot lower. And I think the answer here is, a lot of strategies invest based on like momentum and what's working. And what's working over the last year or so as the NASDAQ, or the last almost 2 full years now, as the NASDAQ blew up and growth stocks fell out of favor, is companies that have stable earnings, companies that have a defensive character, and companies that do buybacks and are just considered to be more reliable. Like, money came into these stocks, and I think it's a little bit like a self-perpetuating cycle until it ends. But while it goes on, it's like, hey, these stocks look great. Buy a little more. Oh, they look even better. Keep buying.
But they're not all in uptrend. So here's the thing. The case was made in 2013, 14, 15 that utilities, staples were overvalued as people use them for bond substitutes, right? Like, I'm going to clip the dividend. But now I just don't understand. So maybe PE is not the right way to look at it, but let's look at I chose free cash flow yield. I don't know what to value these things on, but look at the free cash flow yield. Next chart, please. So I know this might be hard to look at, but hard to say, but it's Walmart, Procter & Gamble, Coca-Cola, Pepsi, Costco. And the free cash flow yield on these things is like terrible. Walmart's under 2%, Procter & Gamble's 3%, Coca-Cola's almost 4%, Pepsi's 2.5%, and Costco's under
Again, these were prized for their dividends and prized for their stability. And it's very rare. Like, it has happened historically, but it's really rare for a company, for example, like let's just pick Pepsi. It's really rare for them to have a massive earnings shock. So I can think of specific examples where like Kraft Heinz blew up out of nowhere. Procter & Gamble, like I remember an episode 20 years ago where it just completely shocked Wall Street. The stock collapsed so badly that like the city of Cincinnati was under pressure. But those episodes are very rare. These are among the stocks with the highest earnings stability, not the highest earnings growth, but the least amount of shit to worry about.
But here's the thing. These stocks are cheaper today based on these ratios than they were like a year and a half ago before all this shit happened.
They're cheaper now.
Yeah.
What were they selling for a year and a half ago? 60 times
30
earnings?
plus. Like, I don't know what's going on. So here's the next chart. So let's look at the free cash flow yield of some of the tech giants. Meta, almost 7. Apple, almost 5. Microsoft, almost 4. Alphabet, almost 5.
Yeah.
Very unusual.
Yeah. The only thing I can come up with is that people prize, stability in a time like this. And I think what's really interesting is taking out the 5 or 10 biggest names. If you go down the next rung, these historically also were always stocks that, like, out of nowhere would get a private equity bid. Like, it would be dangerous to be short these types of names because they always could get taken out. They're the type of businesses that could go private anytime. And that's always been the danger of being short them or being bearish on them or being too underweight them.
So Dollar General, I don't know what, I just thought of this as another example. 23 times earnings, less than 1% free cash flow yield.
Yeah, $1. But again, if more than half of the people in the market think that a recession's coming, Dollar General is the beneficiary of what you're hearing on conference calls being referred to as trade downs. I forget who did it, but somebody did like a thing about how many times trade down was mentioned in conference calls or whatever. Like that's a growing incidence of people saying trade downs. And what that means is it's the Nordstrom customer who ends up at Macy's, or it's the Target customer who ends up at Dollar General. And so don't be surprised if those stocks have a lot of traction right now, given what people think is coming in the second half of the year. Best answer I could muster. Okay, let's move on. Did you read about this girl who sold a fintech business to JP Morgan and she like faked the whole thing? Did you read this article?
Yes. Jamie Dimon was asked about it on the conference call.
Yeah, listen, he's got to defend his people. He can't be like, yeah, we have our heads up our asses. So I thought he gave a good answer. He's like, look, we get up at bat 300 times a year. We're going to strike out once or twice. I think that's fair. But if what's being alleged in the lawsuit against her, and I don't think there's like a criminal investigation, at least not yet. Right now, people don't realize this. It's like civil. Like they're alleging that she ripped them off. And she's alleging, oh, actually, they just want to get rid of me, and now they're smearing me. This is not like a situation where doors are being kicked down yet. It might get to that point. But what's being alleged here is pretty wild. They're saying she got $175 million for this startup that was claiming to process 3 or 4 million people's student loans through the FAFSA program. And they basically bought the list of customers and they hired her. It was like an acqui-hire. And the problem is they went to send a credit card offer to these 3 or 4 million customers, and there was no response.
It was like a 1% open rate or less.
They said like 100 people opened the email. So then it turned out that she was hiring data professors to create fake lists of people to like mimic the existing list she had, which was much smaller. And that's what she sold JP Morgan. And, she's saying, no, that's not true. But I thought to myself, a lot of the biggest companies that have come of age in the last 10 years or so, they kind of were all faking it until they made it. Mm-hmm. They were kind of skirting the edge of various jurisdictions and gray areas and just kind of being like, you know what, this might not be totally legal, but it's also not totally illegal. And if we just get big enough, eventually they'll have to let us do it. And 2 examples that come to mind are Uber and Airbnb, where in their early, and coincidentally, they both started during the last financial crisis.
And how about WeWork?
WeWork's another one, but WeWork is not a $50 billion company anymore. Airbnb and Uber are blue chip tech companies right now. And these are companies that, as recently as 10 years ago, were a little bit of a free-for-all. And just like, it's okay, we have the money, we'll hire lawyers, just keep going. And they I don't want to say they got away with it, but that is the origin story of both of those companies. And it worked out okay. And I think the next generation look at that, as almost like, yeah, that's how you do it. What do you think about that?
Yeah, but they all blew up. Not all of them.
Who's they all?
Yeah. So
a lot of these are hiding in plain sight.
You think Kalanick is like looked at as a hero?
He's somebody that he pulled it off. Like what?
I think he's a little bit disgraced.
Is he though?
The way that it ended, I think.
I bet if I Google his name, he's probably raised money for 2 or 3 startups since Uber, and I think he's fine. And I think for the next generation, of course, we have Elizabeth Holmes and whatever this woman's name is, Charlie Javice. And of course we have these people now because they watched the prior generation kind of pull it off. So I don't know what that says. And maybe there are companies that are blue chip stocks today that their origin story was equally murky. But a lot of people have gotten away with this, and it's like kind of the zeitgeist amongst young people today.
Yeah.
I don't know.
I just want to mention Microsoft, I think, just gave their forward guidance while we were talking because the stock is now almost flat. So maybe that's your bear case. But so one of the things that they said was Satya Nadella said, just as we saw customers, this is from the transcript, by the way, on Twitter. They're great.
Oh, look at this. Yeah.
Just as we saw customers accelerate their digital spend during the pandemic, we are now seeing them optimize that spend. Also, organizations are exercising caution given the macro uncertainty. Here's something that's kind of wild. Microsoft Teams, which is kind of trash in my opinion, is 280 million MAUs. I don't know what that is compared to Zoom. That sounds like a lot. No?
I hate it. And when I get invited to a Teams meeting, I will literally suggest, can we just do Google or Zoom?
So interesting. There it goes. All the gain's gone. All right, let's talk about tech. All right, let's talk about tech layoffs. So this first chart that I have up here, Josh, is the big names and the start date. You know what the start date is? So Meta's on top. The start date
of the chart?
Yeah. Is when Facebook announced layoffs.
Ah, okay. So it's helping.
So this is the playbook. Google did layoffs, the stock popped.
This is a great chart.
Microsoft did layoffs, the stock popped. Tesla's an outlier. That's got its own thing going on. Apple has not done layoffs, and they might not, given the nature of their employee base is a little bit different. Amazon did layoffs. Anyway.
Dude, can you do this chart tomorrow and put a pin where each company announced its layoffs?
Yeah, I should do that.
That'd be interesting.
Before we get into the layoffs, I wanted to get your take on this from Sarah Fisher. So the Department of Justice is suing Google, accusing it of illegally abusing its dominance in digital advertising and violating the Sherman Antitrust Act. Well, they don't see that every day. So here's the numbers. Google brought in $209 billion in ad revenue, making it the largest ad company in the world by far. For comparison, Meta, the second largest, made $115 billion that same year. So 81% of the revenue came from ads. Your thoughts? Any thoughts?
Well, I mean, I think that the antitrust people, the people who are focused on that issue, don't like the double-click business being embedded within the same company that's displaying the ads. So I think that's at the heart. I could be wrong. I have to read more about this. I was asked about this on TV today, and I would just say, like, this happens every 4 years, like the Olympics. It comes and goes. Nobody ends up really caring. Google writes a check. Sometimes they have to write it to the EU. Sometimes they have to write it to the United States. But, like, nothing materially has really changed with Google's ad business other than increased dominance. Count the amount of times they've had to defend it's not a monopoly, because thank God, because of Facebook. If not for Facebook,
Amazon
the pressure would be much higher.
And Microsoft getting involved.
Amazon. I think Amazon has the third largest ads business, and
Microsoft will probably be for not in the not too distant future.
Yeah, I also think the streamers are going to come on in the next 5 years. They're going to take a lot of share from television, and Netflix could conceivably have a huge ad business.
But so Netflix is using Microsoft. So that's what I'm talking about. The market seemed to not mind that much. Google's down 2% today.
The market doesn't really see this as something that has really threatened Google's dominance in the past. Maybe this is the time that, like, oh no, they have to break up their whole business model. That's been a shitty bet historically. That's something from a regulatory standpoint would really impair Google long term.
So this is from Vox. Amazon would soon lay off more than 10,000 corporate employees. They announced, which was a shocking number for a company that hadn't had any corporate layoffs of more than 1,000 people since 2001.
Is that true?
This is from Jason Del Rey, who actually did a great podcast on Amazon a couple years ago. To put the abruptness of these changes in context, as recently as June 2022, Amazon's site had listed more than 30,000 job openings. That's not a misprint. In software development positions alone. By mid-January, it only had fewer than 300. Holy moly. 30,000 to 300.
I guess at a certain point you get so big and you've done so much hiring that the only move is less people, not more. And we got there.
Well, Michael McDonough from Bloomberg had a great chart showing the growth in headcount of a lot of different companies in the S&P 500. And the only one that hockey sticked was all of these giant tech stocks.
Yeah, they were sucking up an enormous amount of potential employees from the rest of the economy. And I think that this is, look, the stat that people keep throwing in my face is that, oh, tech workers are only 2% of or 1.5% of the labor force. And it's like, oh, yeah? Is Amazon even a tech company? In the stock market, it's considered consumer discretionary. And the other thing is the type of people who are losing their jobs right now, I'm calling it a white-collar recession. Mm-hmm. I would say we're already in a white-collar recession. Goldman Sachs, Microsoft, Amazon.
Bankers and tech.
Right, but these are the people that employ a lot of other people. Think about tutors for their kids and personal trainers and private chefs, and think about the type of travel that they do. Like, these are the people whose salaries are so big that they are force multipliers,
no doubt,
in the real economy.
Yep.
This is not Microsoft like the post office laying people off.
Microsoft went red. That's a good point. That's a good point.
So I think we're in a white-collar recession. I understand that you can't get an airline pilot. You can't get a truck driver. I agree. I get that. But there are a lot of people who are losing high incomes, and they are not going to have those incomes replaced anytime soon because all of the other companies that they would go work for are also trying to downsize at the same time. And that's why I think we're going to have a shock. And I don't know when. I just know it's coming.
Well, here's the other thing. The other thing, it's not as if we avoid a recession that they're going to bring them all back.
Somebody's saying tech is a T-shirt recession. Dave Wilson, very clever. I don't hate that.
I like it.
It messes up my narrative to have to say white collar / T-shirt. So we're going to say white collar. But I appreciate that insight. Let's do this tech layoff since COVID-19. All right. Can I just point out Q1 2023 is not even a third over? Like it's coming.
Yeah, no, dude, it's not coming. It's here. Spotify, Wayfair, Amazon, Microsoft, Google, Facebook, Netflix did it early in the year. Like it's here. It's not coming.
I don't have the data, but somebody very
Shopify.
Somebody very smart said the first layoff is never the last layoff. So we're talking about some pretty big numbers.
Who said that
right now? Like per company. I forget, but I believe that there's some validity to that.
Well, no, my rule is if it's a 10% layoff, that's never the first one. You know why? Because you can't
that's what I'm trying to say.
You can't do more than 10. You can't be like, all right, we're cutting 20% of our work. I mean, Twitter did, but normally publicly traded companies, you can't do that. Never. Because it makes it sound like there's a crisis so oftentimes you'll see we're cutting 3% of our workforce, and that's just a precursor to the real cuts that come later. I saw a tweet that I couldn't click. It was paywalled behind Fortune, but that Google's cuts were like algorithmically driven, that it wasn't even human discretion.
There's a lot of things, bullshit being spread about Google's layoffs that has turned out to not be true.
Like what?
And they've kind of lost the narrative a little bit in the way that they're doing this.
You own the stock?
Yeah. There was a thing about I'm okay with the layoffs. I'm a shareholder. No, I'm just kidding. There was a thing about how people were being told come to work, and if your badge doesn't work,
that was not true.
I then heard that was completely debunked, and that spread like wildfire because it sounds like an HBO show.
What if you're spreading the debunked myth? How do you know?
I'm pretty sure where I read that it wasn't true was somebody who works for like an actual journalistic enterprise.
We'll revisit this next week. We'll get to the bottom of it.
Yeah, maybe it is. Maybe they're doing Hunger Games for their employees now. It would be weird if they were doing it. You know what else is I think adding to the dystopic feel of the whole thing once again?
Zombie shows.
I think a lot of tech people, and they're very vocal on Twitter, and they're smarter than everyone else. I think there was like this thing where they were like, "Oh no, what's going to happen to all the truck drivers?" And it's like, oh no. Joe Weisenthal had a tweet. I don't know. I'm paraphrasing, but he said something like, isn't it ironic that the people who are flying to Davos and giving these talks about how all the blue collar people were going to be put out of work permanently. The blue collar work people are fine, and the first people to be displaced are the savants.
Yes.
Like I thought that was kind of interesting. So that's adding to the hysteria. And now you throw in the Chat GPT stuff, and people saying 90% of all content produced for the web will eventually be written by AI. I think there's just terror, generally speaking, right now. And I'm not happy about it. I'm not smiling. I'm just pointing it out. What else are we doing here? Are we good on this topic?
It's up to you. You had a few things, but we can move on.
The
The show's getting long in the tooth. What the hell does that mean? Where'd that phrase come from?
Yeah. All right. We could skip all this stuff. There's a lot of other stuff.
All right. So I'm gonna make. The case.
One
Sure,
thing.
Sure.
I'm sorry. You got like this fund manager in England who is demanding that Alphabet fire even more people, and they probably will. But this is from Fortune. Britain's highest earning investor. This is the highest paid hedge fund manager in all of Great Britain. I imagine he wears a crown to work. He wrote a letter, and this went public, why would you do this? January 20th, Christopher Hone owns a $6 billion stake in Alphabet, wrote to Sundar Pichai, the CEO of Google, take the job cuts much further. This is TCI Fund Management, and he's the founder of the fund, and he wants them to lay off many more workers than the 12,000 already. And here, he says, I believe management should aim to reduce headcount to around 150,000, which is in line with Alphabet's headcount at the end of 2021. This would require a total headcount reduction on the order of 20%. And Fortune then went on to point out, while arguing that Alphabet employees should be paid less, Hone himself has seen his own income surge over the past year. TCI Fund Management founder and director paid himself a dividend of almost $690 million last year, the equivalent of $1.9 million a day. The payout is believed to be the highest annual amount ever paid to a single person in Britain. It is more than 15,000 times as high as the UK's median salary of £33,000. That broke his own record. He paid himself $479 million last year, which brings me to the point I want to make. I think in this day and age, social media, public letter to a CEO, whatever, a really good rule of thumb is, number one, before you say anything, does this need to be said? Number two, does it need to be said now? And this applies to people tweeting about the football player who's maybe dead on the field. Like maybe Skip could hold off a minute, right? And then number three, does it need to be said by me? And I think if you're this guy, Chris Hone, paying yourself $690 million a year, maybe don't do a public letter to the CEO of Google. Maybe call him.
You think he got to that level by being a nice guy? That level of wealth?
I'm not saying, I'm not going to sit in judgment and say he's a bad guy. I don't know anything about him, and I'm sure he's philanthropic out the ass and writing checks to all kinds of charities. I'm just saying, does it need to be said? People are losing their jobs. Do you need to now say, no, that's not enough, fire more? Does it need to be said right this minute as people are being fired? And does it need to be said by me, the highest paid human being in Britain? Do I need to be the one that is the public face of this message?
Apparently the answer is yes.
Okay.
All right. So
I'm done.
I'm going to make the case. But actually, before I make the case, I want to say two things. I want to just say that we are in a period, we're in the midst of a narrative vortex. I wrote about this last week, where their narratives are changing really fast, from maybe it's a soft landing to actually bad news is bad news after 2 down days to we had a sick rebound since then, and now I don't even know what to think. And I'm as guilty of this as anybody else, but just maybe just relax. The narrative doesn't need to change every single day.
Oh, I so agree with that. There's a volatility of opinion that rivals the volatility of the stock market.
Yeah. All right. Mark Rubin, we spoke last week. I'm just throwing this in here just because, shut up, I want to. We spoke last week about Morgan Stanley versus Goldman Sachs, and Mark Rubenstein in net interest had a killer write-up. Just 2 quick charts I want to share. I wouldn't have predicted this. Morgan Stanley kicked the crap out of Goldman, and of course you saw the spread widen recently because Morgan Stanley went into wealth management and Goldman Sachs went after the consumer. And then of course the underwriting blew up, and that's a whole part of it too. But then next chart, John, Morgan Stanley. How about that? Market
You
cap.
said you said it right. They chose the more stable business, and maybe during 2021, the Goldman bankers were high flying. But I think Morgan Stanley as an organization, James Gorman in particular, learned a lot from the financial crisis, and they were able to use that crisis to effectively steal Smith Barney from Citi. They did a joint venture, and then they gobbled up a majority share in the joint venture, and then they ended up buying all of the Smith Barney business and incorporating it. And now they have 15,000 financial advisors in the firm. They are among the most stable employees doing the most reliable business within the firm, and they won. And not only that, they bought lead engines for those financial advisors. So they bought E-Trade and set their advisors loose on that channel, and it's working.
Yeah, it was great.
It was a lot of dormant accounts at E-Trade that nobody had been talking to that actually wanted help.
The head of Morgan Stanley Wealth Management had a huge banner story a couple of years ago. Remember that?
Yeah. Dude, what they're doing absolutely is working. They have this channel of 15,000 talented financial advisors, and they are feeding the channel with potential, like all of the IPO mill and like all the people with corporate stock. Yeah. They are feeding these people to their wealth managers, and it's working.
Okay, so I actually do have a stock, and I don't own this stock, but I might buy it, and I'll let you know next week if I do. All right, So I was looking at like some of the, as I said, the airlines, the casinos.
You should not buy the stock because we're in the same business, and you're a shareholder in Ritholtz Wealth, and you're like adding. Stop.
I'm not talking about Morgan Stanley.
You're adding exposure to wealth management.
I'm not talking about Morgan Stanley. Sorry.
Oh, new stock. All right, go.
My bad. Carl continued tweeted today. This is from Stifel. Vegas leisure demand remains solid, and we have seen no evidence that customer spending is softening. That Las Vegas Strip event calendar is strong. Convention business should return to pre-pandemic levels before the end of the year. Reiterate by Caesar. So I was looking through these charts, and I was looking through the airlines and the cruises. They look good. So Caesar, for example, listen, you don't need to be a technician. This is a clear inverse head and shoulders, no?
Oh, yeah.
I mean, this looks good.
Yeah.
And it is the worst looking, it is the worst performing, one of the worst performing casino stocks. Let's see. Las Vegas Sands is absolutely ripping.
Caesars doesn't have Macau, right?
Exactly. That's exactly right. So Las Vegas Sands is ripping, probably on the back of the China reopening. MGM looks good too. All these stocks are flying. So here's some of the fun. So free cash flow is not looking great at a lot of these companies. They obviously got decimated by the pandemic.
China's response to the pandemic was really the worst part for them, because if China had not done zero COVID policy for 2 years, and China had not been as aggressive against its own millionaires and billionaires, these companies would be in much better shape. But the story now, Wynn is the one, by the way. Like Tillman Fertitta has a big stake in Wynn. Steve Wynn is gone. All of that bullshit is gone. And they are, if Macau and China truly have this reopening, that's where you're going to make your money. I like that one better than Caesars.
Okay. You might be right. Anyway, also, let's just look at performance. So Las Vegas Sands has done the best. This is, I think, just over the last year. A lot of that has come in the last 3 months as China has reopened or is about to reopen or whatever. Then Wynn, MGM, Caesars, and last. S&P is down 7% of that time. Anyway, I think it looks good. I don't yet.
Caesars also. Good. Caesars
DraftKings too. Not DraftKings. Yeah. You know what I mean. The draft app. The draft.
Yeah.
App.
So Caesars
the betting app. Jeez,
Caesars is fighting it out with the other betting apps, and I think that business is objectively a terrible business.
They're losing less money on it, but we'll see what happens when they report earnings.
It's a great business for the states. The states are collecting windfall amounts of tax. I read that New York State got like $700 million from the gambling apps last year in taxes. So it's great for the states. It turns out to not be so great for the companies that are fighting it out for customers.
Today, the customer acquisition costs are ludicrous. They're all hemorrhaging money. I do suspect that you're going to see dramatic expense reduction in the most recent quarter on that front. We'll see. But anyway, forget all that. Who cares about that? The stocks look good. That's what I'm saying.
Okay. All right. Like it. I have a mystery chart, and then we're going to close out. I'm going to do a small build-up, but nothing crazy in the interest of time.
Okay.
Pop my chart. Okay, this is so stupid. All right, let me.
Oh, I
can
know
I
what
just
this
tell you
is.
what this is?
I do know what it is.
Oh, do it. Say it.
By the way, Microsoft's down 1%. Hold on, Duncan. Do the
Drum roll.
Drum roll, but don't reveal it until I say it. I think I know what this is. Drum roll, please.
It's year to date something.
It's GBTC versus Bitcoin. No, it's not.
Terrible. Not even
All right.
close.
Well, all right.
All right. The purple line is year to date. Microsoft,
hell is
Apple,
this?
Amazon. Microsoft, Apple, Amazon, Alphabet, and Meta. The big five. The yellow line is the S&P.
Okay.
So the FANGs.
Samsonite. I was way off.
The FANGs got off to a roaring start in January versus the overall S&P. More than double the performance for the big five S&P names that a lot of people just kind of like wanted to pivot away from. Those stocks so far this year, I don't know what's going to happen tomorrow, but so far this year have had quite a bounce.
So
I just
Microsoft
wanted to
was
point
up
that
5
out.
in the after hours. Now it's down 1. So tomorrow should be interesting. We'll see.
All right. Well, listen, guys, we've kept you a long time tonight. Thank you so much for sticking with us.
Happy birthday, Rogers.
Happy birthday, Roger.
Yo, buy one of these shirts.
Congratulations,
You should feel these things. Unbelievable.
Check out Tropical Bros. Tell them Animal Spirits and What Are Your Thoughts sent you. And we will see you guys tomorrow. New Animal Spirits.
Good night.
Yes?
That's right.
Yes?
That's
All
right.
We'll see you then.
Good night.